Ladies and gentlemen, welcome to this press conference with General Counsel, Chairman Ambassador Bruce Gosper, and Director General Pascal Lamy. Thank you for your patience. The General Counsel has just concluded. Chairman Gosper will begin with a brief statement, followed by the Director General, and then we'll take your questions. We'll have about 30 minutes. Ambassador Gosper, please.
Thank you very much. Welcome. The purpose of the informal Heads of Delegation meeting, which was just held, and which I convened in cooperation with the Director General, is to enable the Director General to report to members on the proceedings of the meeting he held this morning with major providers of trade financing, to examine the impact of the financial crisis on developing country access to financing of imports and exports. Today's meeting was also an opportunity for an exchange of views. The meeting this afternoon concerning the impact of the global financial crisis on the availability of trade financing and more generally on the trade implications of the crisis and the response of the WTO. The Director General is available to brief you on this morning's meeting, and I'll now pass over to the Director General.
Thanks, Bruce, and I'm glad you are here so that everybody can see I'm speaking under your control. As expected, this afternoon's meeting, where I reported on this morning's meeting, was partially devoted to this trade finance issue, but also to more generally the impact of the financial crisis on trade. Now, starting with trade finance, what I reported to the members from the findings, the discussion, the interaction which took place during the whole morning, with a panel of commercial banks, export credit agencies, and international financial institutions, World Bank, regional development banks from all over the world. The message on trade finance is reasonably clear. First, looking at the market, the situation is bad, and the odds that it gets better are very thin. And this is true both in terms of volume and in terms of prices. Volumes have decreased and prices have increased, which is the signal of a market where there is a mismatch between supply and demand. Why has this happened? Two main reasons. First, lack of liquidity. Second, risk reassessment. What is done and what has to be done. Again, not that the World Trade Organization is a prescriptor. This is outside the competence, the remit, the perimeter of the World Trade Organization, but it impacts trade a lot, which is why countries like Egypt or Brazil, to take these two examples, have supported us doing this. Number of actions already taken to try and mitigate this situation. The World Bank has announced a tripling of the ceding of trade finance guarantees under the IFC business they have on this, and they are pushing it from $1 billion to $3 billion, which is a big, very big increase. The president of the World Bank has just announced that he would be putting this to his vote. Export credit agencies, who are regrouped in what is called the Berne Union, have obviously stepped in. Their business has increased by 30% in the last 2 months because they cover not the liquidity part of the problem, but the risk part of the problem. And they've been backed to do that by some national governments. Three examples. Germany has just done that. Hong Kong has just done that. Japan, we understand, is in the way of doing that. So there's already been a reaction. More needs to be done, and that's what they all say. First, in providing liquidity, and if necessary, earmarked liquidity. Second, in mitigating the effect of the increased perception of risks, which basically means that a number of public authorities, government, central banks, need to step in to provide more support, as, by the way, they've already done it, to mitigate more complex risks than trade finance, which we all know is not rocket science. What's the size of the liquidity problem? Rough number, which appeared in the discussion, not something that's the result of complex calculations or simulations. The order of magnitude of what they see as the lack of liquidity is $25 billion, which in itself is a big number, as compared to other numbers which we've seen recently appearing when governments and central banks have stepped in, probably a relatively small amount compared to the amounts injected into the banking markets. Knowing that doing this in trade finance has a huge multiplicator effect in terms of keeping trade afloat, especially for developing countries, and notably emerging markets, which are big trading markets nowadays, but where the risk assessment has obviously deteriorated. Medium term, there is an obvious need to improve mechanisms of information, risk sharing, risk assessment techniques, data collections, and we'll be working on that. The basic message, in order for your readers or viewers to sort of try and understand what they're after, is very simple. The basic message is that trade finance is the most secure, the safest, the less toxic asset which you can trade in banking and insurance. So on the one side, it's much safer than many other risks. On the other side, the absence of coping with that is a big hit for poor developing countries. And this is the message which will be sent to finance and leaders meeting in Washington on the 15th of November on this trade finance issue, and I hope they will pay the necessary attention to this part of the problem. Second, more generally, on trade and the financial crisis, as expected, many members expressed views on this during the informal session of the General Council. We basically heard two messages. One, please make sure we all keep trade open, which means resisting protectionist pressures, which will be there in the coming months. Second, let's try and reinforce this insurance policy we have together on trade by concluding the round as soon as possible, which means many calls to achieve modalities on ag and on industry before the end of the year, which then would mean, obviously, to step up the pace of work here. This message, by those who've emitted it, was coupled with this notion that it's extremely important that for developing countries, the development content of the round should materialize as soon as possible in the background of this economic crisis. These messages will also go to the G20 meeting, not least by the members of the G20, most of them, not totally all, but most of them being members of the WTO. The best way to ensure coherence between what we say here and what will be said in Washington is that we recognize that WTO is member-driven, that the G20 is member-driven, and as there is a large commonality of members, coherence should not be a problem, even if the main agenda for the meeting on the 15th is the coordination of economic stimulus and the first steps towards a more efficient global finance regulation. So that's my briefing. To conclude it, I'll just pick up on one sentence, which I think is a pretty good summary of the situation, which was pronounced by the chair of the ACP group this afternoon, when he said that trade is the oxygen for developing countries. Let's make sure, in addressing these various bits of the problem, that oxygen does not dry up.